Welcome to Market Brief After Hours. We have a packed episode for you today. It was a wild session across the globe. We saw a massive rotation out of high-flying tech and artificial intelligence stocks, a dramatic spike in oil prices following geopolitical tensions in the Middle East, and some eye-opening economic data from both sides of the Atlantic. The U.S. markets had quite a reversal today, didn't they?
They certainly did. It was a classic risk-off day, especially for the high beta sectors that have been driving this bull market. The Dow Jones Industrial Average actually hit a new all-time intraday high earlier in the session, but ultimately pulled back, losing 131 points, or about 0.3%, to slip below the 53,000 level, closing at 52,869. Meanwhile, the S&P 500 fell 0.5%, and the tech-heavy Nasdaq composite took the biggest hit, sliding 1.2%.
That tech slide seems to be the big story of the day. We've been talking about the AI trade for months, but today it felt like the air came out of the balloon a bit. What triggered that?
It really comes down to sky-high expectations meeting reality. For a while now, the market has been pricing in absolute perfection for artificial intelligence and semiconductor companies. Today, we saw a significant rotation out of those names. Micron shares plummeted 7%, and we saw deep declines across other key players like KLA, Marvell Technology, Broadcom, and AMD. In fact, the VanEck Semiconductor ETF, which tracks the sector, fell more than 5%. When expectations are this elevated, even solid fundamentals struggle to keep pace, and that's exactly what fueled today's decline. Investors are starting to ask whether these valuations are sustainable in the near term.
But the money didn't just disappear from the market entirely, did it? It looked like a classic sector rotation. Where did investors find safety?
Exactly. This wasn't an outright panic sell-off. It was a rotation. Money flowed out of chips and into defensive and value-oriented sectors like healthcare, financials, and consumer staples. Eli Lilly gained 2%, while JP Morgan Chase and Microsoft also managed to post gains. We even saw Walmart shares climb higher. Walmart actually made headlines today by announcing price cuts on everyday products like ground beef and Coca-Cola, which seemed to resonate well with investors looking for stable, consumer-facing businesses.
That makes sense. Now, before we look at the broader U.S. economic data, this tech sell-off didn't actually start in New York, did it? It felt like a global wave that began overnight in Asia.
Spot on. The downward pressure really began in the Asia-Pacific markets, and the epicenter was South Korea. The KOSPI 100 index plunged a staggering 5.28% to close at 9,605. The sell-off was so intense that the South Korean exchange actually triggered a circuit breaker, halting trading for about 20 minutes after the main index fell more than 8% intraday. This was the 6th time a circuit breaker was activated this year.
A circuit breaker halt is always a dramatic headline. What was the catalyst there?
It was Samsung Electronics. They reported a massive 19-fold jump in second quarter profit, which sounds incredible on paper, but the stock still dropped 6.92%. Investors are deeply concerned about future capital spending and whether demand for memory chips can keep up with these astronomical expectations. It's a classic case of good news is no longer good enough. When a company reports a 19-fold profit surge and the stock still drops nearly 7%, it tells you expectations have completely outrun reality. SK Hynix also dropped over 6% in sympathy. Adding to the tech anxiety, reports emerged that Chinese firm DeepSeek is developing its own AI chip, which could eventually cut dependency on Western giants like Nvidia and Samsung.
That's a massive shift. And South Korea wasn't the only Asian market feeling the pain, right?
No, it was a regional retreat. In Japan, the Nikkei 225 fell 2.12%, while the broader topics declined nearly 1%. Major tech and industrial names like SoftBank Group, Tokyo Electron, and Advantest were all down. Interestingly, Sapporo Breweries bucked the trend, surging 7.91% after announcing a $643 million joint venture with Carlsberg to expand their footprint in Southeast Asia. Over in China, the Shanghai composite fell 1.26%, and Hong Kong's Hang Seng index slipped 0.51%.
It sounds like a complete positioning flush across Asia. What about Europe? Did they escape the carnage?
Not entirely, though the declines were slightly more muted. The Pan-European Stoxx 600 shed 0.65%, Germany's DAX fell 1.37%, and France's CAC 40 ended lower by 0.51%. On the positive side, the UK's FTSE 100 managed a tiny gain of 0.13%, and Switzerland's SMI rose 0.41%. We also got some interesting economic data from Europe. Germany's industrial production unexpectedly rose by 0.9% in May, marking its strongest reading since March 2025, which was a nice surprise. However, France's trade deficit widened to 6.9 billion euros, driven by lower exports of electronic and computer equipment. In the UK, house prices grew for the first time in 4 months, rising 0.2% in June, bringing the typical property price to just under £299,330.
Fascinating. We need to take a quick break, but when we return, we'll dive into the U.S. economic data, the sudden spike in oil prices, and a very technical look at the Forex and precious metals markets. Stay with us. Welcome back to Market Brief After Hours. Before the break, we outlined the global tech sell-off. Now, let's bring things back to the U.S. economy. We received some fresh data on trade and employment today. What are the key takeaways there?
The macro data today painted a picture of a cooling domestic economy, but high consumer demand for foreign goods. U.S. imports rose by 3.3% to a 14-month high of $395.3 billion in May, driven heavily by pharmaceuticals, cell phones, and passenger cars. On the flip side, U.S. exports fell 3.2% to $317.7 billion, largely due to a drop in industrial supplies like non-monetary gold and natural gas. This brought the U.S. trade deficit to $77.6 billion. Meanwhile, on the jobs front, private employers added an average of 21,000 jobs per week in the 4 weeks ending June 20, according to the ADP Research Institute. That's a step down from the previous period's 24,250, and aligns with ADP's overall June report, showing only 98,000 private jobs added, the lowest in 3 months.
So economic growth is showing signs of cooling, but interestingly, Treasury yields went up today. Why is that?
Yes, yields moved higher across the curve. The 30-year Treasury bond yield rose above the key 5% level, settling at 5.053%. The benchmark 10-year yield added over 6 basis points to land at 4.545%, and the 2-year note ticked up to 4.179%. Investors are highly sensitive right now as they look ahead to the FOMC meeting minutes. This will be the first set of minutes led by the new Federal Reserve Chairman, Kevin Warsh, and everyone is searching for clues on the future path of interest rates.
Absolutely. All eyes on the Fed. Now, let's talk about commodities, because oil had a very volatile and upward day. What's happening in the Middle East?
Geopolitics took center stage today. Oil prices jumped after Iran attacked a Qatari liquefied natural gas tanker near the strategically vital Strait of Hormuz. This is a critical choke point that handles about 20% of the world's oil traffic. The attack highlights how fragile the U.S.-Iran interim peace agreement really is. In response, the U.S. Treasury Department revoked its authorization for Iranian oil sales. This sent Brent crude futures up 3% to settle at $74.16 per barrel, while U.S. West Texas Intermediate futures gained 2.8% to close at $70.44.
That's a significant move for energy. But precious metals went the other way. Gold and silver both had a rough session. What are the charts telling us there?
Precious metals got absolutely hammered as the bearish momentum accelerated. Silver plummeted 3.00% to close at $60.23, trading way below its key moving averages. To give you some context, silver's 50-day simple moving average is sitting up at $71.14. Its 100-day is at $74.94, and the 200-day is at $69.14. So trading at $60.23 shows a deeply entrenched downtrend. Gold didn't fare much better, falling 1.19% to close at $4,115. It rejected intraday highs of $4,180 and remains heavily suppressed below its 50-day SMA of $4,403 and its 200-day SMA of $4,465. Sellers are firmly in control of the metal space right now.
That is a very clear technical picture. Let's stay with the technicals and look at the major currency pairs. How did the foreign exchange market react to all of this global drama?
The Forex market showed some really defined trends today. Let's start with the euro. The euro-USD pair consolidated near its recent lows, closing down 0.22% at 1.1416. It's trading well below its 50-day SMA of 1.1577 and its 200-day SMA of 1.1650, which confirms a dominant bearish trend.
If it breaks below the immediate support of 1.1408, we could see a retest of the key structural low near 1.1350.
And what about the British pound? Did it face similar pressure?
Yes, the GBP-USD pair retreated, closing down 0.21% at 1.3362. The daily candle showed a clear rejection as the pair tried to push through a dense cluster of moving averages. It closed just below its 50-day SMA of 1.3402, its 100-day SMA of 1.3405, and its 200-day SMA of 1.3399. That represents a massive wall of overhead supply. If it can't break above 1.3405, we might see it slide back down towards structural support near 1.3250.
Interesting. Were there any currencies that actually gained ground against the greenback?
The Swiss franc was a notable exception, or rather the US dollar surged against it. The USD-CHF pair closed up 0.39% at 0.8081, printing a strong bullish candle. The pair is trading comfortably above its 50-day SMA of 0.7928 and its 200-day SMA of 0.7911. The bulls are firmly in charge here, and a close above 0.8120 would confirm a continuation of this upward trend.
Excellent breakdown. Now, before we wrap up, we have to look at some of the individual stock stories that caught everyone's attention today, the market movers. There were some massive percentage moves.
Oh, absolutely. Let's start with the biggest winner of the day, Kronetix Pharmaceuticals. Their shares skyrocketed over 98% today. This massive surge came after Vertex Pharmaceuticals announced a definitive agreement to acquire the company for about $10 billion, which works out to $85 per share. Just an incredible day for those shareholders.
Wow, nearly doubling in a single day. That's the dream scenario. Who else made big moves?
On the flip side, Rivian Automotive had a brutal session, closing down more than 18%. The electric vehicle maker offered to sell 75 million shares to fund equity contributions for a U.S. Department of Energy loan. Investors clearly didn't appreciate the dilution. We also saw USA Rare Earth lose more than 8% after reports emerged that a group of Democratic lawmakers is expanding an inquiry into the government's $1.6 billion investment in the mining company.
And what about Cognizant? I saw they had a green day.
Yes, Cognizant Technology Solutions closed up over 6% after announcing an expanded partnership with Google Cloud, which gave them a nice lift. And finally, SpaceX shed 6% on Tuesday. This decline is particularly notable because it coincided with their entrance into the Nasdaq 100. Despite a flurry of bullish coverage and positive price targets from Wall Street heavyweights like Morgan Stanley and Raymond James, the stock fell. Analysts noted this is likely a modest risk-off move, given SpaceX's positioning as a key player in the AI ecosystem.
It seems like even the biggest names aren't immune to this broader market rotation. Well, that is all the time we have for today's deep dive. If you found this useful, please follow Market Brief After Hours for your daily dose of market analysis and financial insights.